Hi, I'm Jim Jackson, and I'm bonding over bonds with my colleague, Kevin Kazi. So it's been about a month, Kevin, since we bonded over bonds, but we both took some time off. But I think we can both say that the bonding never really stopped.
It never does it?
It doesn't.
It is good to be back. Over the last month, we've seen the 10-year Treasury bounce around 1.25%. Corporate spreads have kind of been range bound between 85 and 90 basis points. Looking at the market action has been fairly benign, even considering the Fed talk, Delta variant, and some maybe weaker economic numbers.
The one thing we've also seen is the CPI numbers for July were below expectations month over month for the first time in several months. So it is possible that this could indicate that the inflation concerns are easing somewhat, but we're still also seeing very strong corporate earnings for the second quarter.
We sure have. I mean, another thing is the corporate issuance has been very strong, and liquidity has remained pretty solid. This week we hit our 1 trillion mark for new issuance compared to May of 2020, and we're definitely ahead of 2019, which occurred in October. So, Jim, I mean, you're spending a lot of time talking to clients and other people. What are their concerns? What are you hearing from them?
Kevin, I'd say it's pretty consistent that clients' biggest concerns are inflation, treasury rates, and credit spreads.
Sure. I mean, that's kind of that's consistent across Wall Street right now.
Sure.
The challenge really here is that for investors is that, these factors are impossible to predict.
Yes, they are. I mean, the one thing that we have looked at is how credit has performed in rising rate environments. So our analysis shows that credit spreads are negatively correlated to rates. So when rates go up, credit spreads have the potential to either stay flat or decline, potentially softening any bond price decline from rising rates. However, I would caution that just because that's happened in the past doesn't mean that's what we'll see in the future. We still think it is a good time for active fixed income management of credit, but we would continue to stress that investors should have a consistent approach to fixed income within their risk tolerance and to ensure that they stick with their asset allocation over time.
Agreed.
So thank you for bonding over bonds with us.